All right, hey guys, William LeBaron here with MonitorBase, and I've got David Boswell with Misely on the call today. So the goal today, I'm just going to lead this out with a question, and that is, why should clients trade a lower rate for a higher rate in today's market?
So it really is dependent on their overall financial situation, because what we tend to focus on in the industry is their mortgage and how that can help them in terms of their payment, their cash to close, things like that. But when we're thinking in terms of their holistic financial profile, given variables like how much debt they have, revolving installment debt, uh, we've got to consider that as a part of what we're going to present to them and how that might impact them financially. So, really, for instance, it's, more looking at the blended rate of the solution that we're presenting. Because if they have a 3% rate, but they have 16% interest on other debts like revolving or installment loans, then if you blend those rates together, the outcome, when we actually do the real math, the outcome might actually paint a different story.
So for us, I relate to that because we do a lot of predictive analytics. Several of our predictive alerts actually do the calculation. And what we look at is installment debt, revolving debt, mortgage debt, underlying rate, and mortgage insurance, and then compare that to LTV, and we can run through the calculation and basically say, hey, William has enough equity that he could pay off these debts, and the net effect would be this much of a reduction in his monthly debt obligations. And so we call those predictive debt consolidation alerts. But I think it's relatively simple for us to do that and show a loan officer that math, because you've got the structure in your head of how that all fits together and you've run through similar scenarios. But I don't think the clients have done that math maybe ever in their life. And if they have, it's been perhaps one or two times. It's not something that's intuitive. So how on your end how do you convey that financial impact in a way that makes sense to them? How is the Misely tool built to address that?
That's a great question. So, we've done a lot of work in trying to simplify the presentation as much as possible. So what we do is we focus on one chart. It's a bar chart that maps out the equity build in their home, as well as any investment rates of return or tax savings or just savings in general, that really paints that picture of which option is going to net them the most impact financially. And what we're talking about with debt consolidation could be, a very simple example where they have all this equity in their home that is really sitting dormant, not really doing anything for them other than, continuing to build and build and build. Whereas on the opposite side of this, they may have a lot of debt. And if you look at the comparison between staying the course, paying that, let's call it a low interest rate on their current mortgage and having all that equity in the home, versus if you were to take a cash out refinance and pay that debt down. So we're modeling that financial impact for both of those options. So stay the course or do a cash out refinance. And when we churn that math, oftentimes it will paint that picture that it's better to do the cash out refinance. Now, Misely is not designed to always convince somebody to do a loan. It's really designed to help them make a more informed financial decision. So even though we would love for it to benefit them to do a refinance and cash out and pay off debt, in some circumstances, maybe it's not. And I think that's also valuable. So the tool is designed to put you in the driver's seat to give them some financial, indication as to which option they should do. Should they stay the course or should they do a cash out refinance? Hope that made sense.
I think so. So one of my questions ends up being, how does this differentiate? How do you help a loan officer differentiate themselves? How are you helping a loan officer solve this? Because I think I was a loan officer about 8 years ago, and you had various disclosures, and I spent a lot of time trying to explain to a client what was on a GFE. But at the end of the day, there are other products like yours, but how does Misely, or how do you specifically help loan officers differentiate themselves to their clients? Are most loan officers using a version of something, whether it's yours or Misely or otherwise, or is it really that most loan officers still just rely on those disclosures?
Yeah, I think for the mass majority of the community is really still using the disclosures, the loan estimate, or a spreadsheet that they put together, or the worksheet that comes out of that mortgage software to help the client understand what the cost of the loan is, what the rate is, what their payment is, what their cash to close is. So but however, there are a good percentage, and it's growing, of loan officers that are starting to realize that their role as a mortgage professional is more about money, right? It's not about a loan, it's about money. And money is not just the loan, it's the equity in the home. So what Misely does and what these other platforms do, they are financial tools. They're not a worksheet, they're not a spreadsheet, they're not a disclosure. They are designed to help professionalize the business and help build trust and loyalty in the conversation with the client. So it's not about fees and costs, it's about how we're going to help the consumer make that financial decision. Not just this financial decision, but this financial decision sort of domino effects into other life events that they might have down the line, like weddings and college tuition for their kids, retirement, helping an elderly family member through a tough time. So, and that's really what distinguishes Misely from the others that are out there is that, this actually helps the loan officer actually forward think with their clients versus it just being about the now. It's helping them understand when you make this decision, how is that going to impact other life event expenses that you have coming up and overall financial wellness. My mission is different than my purpose, right?
Explain that.
So my purpose is to help every consumer at the time that they're ready to buy or refinance make the most informed financial decision, forward thinking, like I was saying about life events, right? So it's about life event expense planning. And the home is one life event. The move up is another life event. The move down is another life event, and the move on is another life event. But in between, you have the weddings and the college tuition and the emergency funds and the things that most of us in this industry aren't talking about, because there's really no way to manage that until now, right? So Misely is that tool that it can actually help the loan officer help their client make that most informed financial decision. So the purpose is to help the consumer make a more informed financial decision. The mission is to get this in the hands of every single loan officer so that they can build that level of trust and loyalty to their brand and have a reason to contact the client every 6 months if they want to. Hey, how are your life events going? I mean, this is really the objective, is to be more engaged with the client, be more relevant to the client, and ultimately, it's a benefit for not just the loan officer, but for the consumer.
What you're describing there is a big part of what we try and focus on in our system, is finding when is the right time to engage, and having the information in front of you, the credit profile, the debts, the balances, the payments, all of that information available, so that when you're having a conversation, you're armed to help that person out and help them make the right decision. And it's not like I'm pressuring you into taking a loan application so I can gather this information from you and then I can try and twist your arm behind your back and get you to do a refinance because I need this commission. And it's like, no, we do all of that analysis on the back end. We find the best opportunities. We notify you, we give you the credit profile so you have everything that you need to do all of this math. And then when you're having that conversation, you actually have something to bring to the table, numbers for them to consider and look at, as opposed to just being in intelligence gathering mode, which, I don't know about you, but for me, like, if someone is asking too many questions too much up front, I feel like they're backing me into a corner. It's that sales technique. And if you can actually come to the table without having to ask them all of their latest life updates, but instead be providing a really comprehensive and thoughtful proposal of what is possible, that makes a very different experience, I would say, from the customer's perspective.
Right. Yeah, I agree. And the tool that you have is so important to the industry because of what you just said. I mean, you're calling and you're checking in and you're probing, right? Versus calling and checking in with a purpose, right? Now, not to be creepy about it, but it's it can be tactful in a way that have you considered this, right?
Well, it's that context, because I'm calling with something specific in mind that's relevant to you, and we already have a relationship and a connection. And I did your last loan, and I have your social security number on file, and your previous income docs, and a whole set of information. So there's a fair amount of information that you already brought to the table in the relationship. And so being able to step up and use the information you have to make those proposals, it's not coming out of the blue. It's not like I'm calling a random stranger. It's someone that's previously, in a lot of cases, done a loan with me. We've gone through all these conversations. I'm just using updated information to say, hey, have you thought about this? And let's talk about what that might look like and see if it's a good decision. And then, I don't know, I can't think of something more optimized to confuse people than a good faith estimate and truth in lending disclosure. But it's been a while since I've been a loan officer, so maybe the world is better with some of the new disclosures today.
No, it's actually gotten worse. I mean, the LE is actually more confusing than good faith estimate. It really is.
Hard to imagine.
One page, one or two pages to 4 pages. That one didn't make sense. But anyway.
Yeah.
But I agree. I think that instead of having a CRM, which CRMs are good, you keep in contact with them, you keep organized, and you keep data on your clients. But the drips and the appreciation events are great. But when you call with something that's intentional to help the client make a financial decision that could benefit them in a way that they never even imagined, just think about the trust and loyalty that you're building there. And your technology where it could facilitate that, putting that in motion, right? And then on the backside of that, a technology like Misely that can actually simulate the benefit, right? And it's all about helping the client make financial decisions, and that indication that you're providing and the details that we're able to present to them financially, the real math is where the rubber meets the road, in my opinion.
I mean, I can do simple math in my head, but I can't do mortgage math in my head. And so I think being able to condense it into something that's understandable for just your average consumer to be able to look at it and say, okay, these are the two forecasts and these are the couple of variables at play. and this one makes the most sense for me, is what is, I think, necessary here. So that's really what I like about the synergy between the two systems.
I agree. And you brought up a great point, because we were talking about this at one other point in time about, the conceptual understanding of the numbers, right? And most of the time, especially somebody with a really, really low rate, maybe they've got a 3% interest rate on a very large loan, right? And then they have this other credit card debt or installment loans or a combination of the two, that is relatively lower. So in their mind, and it's natural to believe that I should just stay where I am with the 3% rate, because why would I give that up, right? Without seeing the real math, you really have no concept of how that will or will not benefit you. So I think it's important, to have ways that you can show this to the consumer.
David, it's great talking to you today about this. I think today, as much as it's ever been, incredibly important that loan officers can differentiate themselves, not only from other loan officers, but just, standing up above the service level that people are used to receiving. Because in my experience, service levels have not been getting better in the past decade. They've been getting worse in just about every category. So for someone to step up and be above and beyond to build that connection and that relationship and that trust, by being very good about conveying complex information in a simple way that I can understand, by giving that extra effort to make sure that I'm not just being moved through the process, but being educated in that process, I think it makes the difference in creating long-term loyalty, which ultimately I think should be every lender's and every broker's, every banker's objective, to create that long-term loyalty. Otherwise, every year you have to restart and find a whole new set of customers. And, that's not as good as having a whole set of customers who love you and trust you and want to work with you the next time they're in business. And that's our whole business model. And I think apparently that's yours as well.
Absolutely. And, I think it's important to get comfortable being uncomfortable. And what I mean by that is that, most people don't like to learn new technology. So, to that point of building long-term trust and loyalty with your clients and having a reason to check in with them beyond just the drip mail and the appreciation events, we have made it, and I'm sure you have made it as simple as possible to get ramped up on this technology. I don't know, I can't speak for you, but I think you are the same way, is that you're not going to just leave the new user, to the wolves, right? And teaching themselves. So we have a lot of good training that we do, and it's really just being comfortable, being uncomfortable for just a very short period of time. And once you get to that other end of that, it's all uphill from there. It's all up from there. If that makes sense. So anyway, yeah, I'm real happy that we had a chance to connect. I think our technologies are very synergistic with regard to this, and I'm excited to see where this goes.
Awesome. Great to talk to you, David.
You too. Thanks, Wayne.